Chapter 13, recognizing employee contributions with pay. So LOs, discuss the connection between incentive pay and employee performance, describe how organizations recognize individual performance, identify ways to recognize group performance, explain how organizations link pay to the overall performance, describe how organizations combine incentive plans and a balanced scorecard, summarize processes that can contribute to the success of incentive programs, discuss issues related to performance-based pay for executives. So incentive pay. So realistically, when you look at incentive pay, this is something that's designed to promote good behavior and productivity in the workplace, and they do it in multiple different ways. You know, it's to energize, direct, or control employees' behavior, to try to get them to excel at their job and be competent at their job. And you have various different ways how this is done. Employees consider a plan to be fair when the rewards are distributed according to what they contribute. Basically, what I do and I get this, I view that as being fair. And there's different forms to look at the bonus, commissions, various ways, and we'll talk about that. So effective incentive pay plan requirements. So you have performance measures are linked to the organization's goals. Employees believe that they can meet performance standards. Employees are given resources needed to meet those goals. Employees value rewards given. Employees believe the reward system is fair. Pay plans consider employees may ignore any goals that are not rewarded. So when you bring all this in together, the employees, they got to set up something. It's got to be something that's viewed as fair. It's got to be something that they can meet. It's got to be aligned with what the company needs and where you're trying to go and what you do. And realistically, if you have a pay incentive plan in place where the employees feel like if I do this, then you give me that, it ain't fair, they will ignore it. So and there's different types of things we look at incentive pay. So one is wages based on the amount an employee produces, and this is referred to as production. If you make for every 10 items that you make, you get this, or for every item that you make, you get this dollar amount. So they know what it is, and that's referred to as production. Straight piecemeal. Employer pays the same rate pay piece no matter how many the worker produces. So you're going to get this. Bottom line is to produce so many pieces of work, you get this. So if they go over that, they still get the same rate. Differential piece rates. Piece rate is higher when a greater amount is produced, also called rising and falling differentials. So you get so much money for producing 10, but if you produce 15 to 20, you get more. If you produce 20 to 30, you get more. Standard hour plans. Employee workers pays workers extra for work done in less than preset standard time. Encourage employees to work as fast as possible. Employees often neglect quality or customer service. So when you just have standard pay, they get their standard pay. You know, bottom line is they know whether they excel or they're a little bit slow or don't get it quite done. They know they get the standard rate of pay. Merit pay. Pay increases are linked to ratings on performance appraisals. Uses a merit increase create performance rating comp ratio. So when you look at this merit pay, this is something when it's like, okay, well, over the past year, you have 4 evaluations, each quarter. In each one of those quarters, you exceeded the goals that were set for you. Subsequently, you are getting merit pay. Now, if they sit down with another person and they look at it and say, no, we look at your 4 evaluations over the past year, and you are actually just meeting the bare minimum and stuff, they do not get merit pay. So performance rating, you look at this, you see 80 to 90%, 91 to 110, 110, 111, 120. So this is when I told you, and this is how you would normally see if you haven't had performance appraisals before. This is what they'll be like. Usually, are they below the standard? Do they meet the standard? Or are they exceeding the standard? And so, the comp ratio is employee salary divided by the midpoint of their salary range. So they use this ratio, and then they look at the rating, performance rating, to determine how much someone is going to be compensated. So it won't be anything people can look at it and say, well, I'm trying to figure out how I got paid. They'll know exactly how they can get paid, why they got paid that amount when they utilize this. Ratings and raises under rewarding the best. So you see high performers, you look at that. You see middle performers, you see low performers. So if you have high performers, usually in the organization, people knows what these are. They expect to be rewarded for what they do. A lot of times when you have middle level performers, these are the folks who are inclined to say they're doing what it takes to get the job done, but they're not overachieving. And then you have low performers, and those are the ones they never qualify for anything, and eventually, if they continue to be a low performer over a period of time, extended period of time, you're looking at possibly replacing these people. Pay for individual performance. So performance bonuses, not enrolled into base pay. Employee must re-earn bonus during each period. Maybe a one-time reward, maybe linked to objective performance measures. Retention bonuses give employees a reason to stay. So when you look at this is where basically, let's say that each quarter you're getting evaluated. Well, they may say you're eligible for a bonus each quarter, but they're going to go through to see, are you excelling or whatever else. And they may give you something each quarter for that. Or they may say, if you excel in each quarter, we'll give you something yearly, which will be a one-time reward. So it's going to be linked to the performance. No doubt about that. And then there's this thing called retention pay. This is something I wasn't aware of until I retired from the military and the government and started working with corporate America clients. This is where a company will come to you and say, you know what, you're such a valued employee, you do such a great job. We will give you $30,000 if you promise to stay with us for at least 2 more years. That's on top of their pay. That's retention pay. Performance bonuses. So performance bonuses are for production workers are not rolled into the base pay. These bonuses could be tied to various measures, including the quantity of products being shipped in a specific time. So this is when you have folks, it's like, okay, again, if you make so many, what you can calculate what you're going to make based on the bonus structure. Pay for individual performance, sales commissions. So this, a lot of times we think of people who are like insurance salesmen or people who sell financial services. You see this a lot of times, or people who sell automobiles. Incentive pay calculated as a percentage of the sales. May earn commission in addition to base salary. May work on straight commission plan with no salary. May earn no commissions at all. So when you look at this is you'll find it set up 2 different ways. Some will be set up where you have a base salary and then you get some commission on top of that. Some will be straight commission with no base salary. And some may not earn any commissions at all. Let's say if you're straight commission, but you don't earn any commissions at all, you won't be paid. So when you look at this, you gotta say, well, which one is best? You can't say which one is best because you gotta look at what type of company you are, what are you selling, or whatever else. I'll give you an example. You may say, well, I would prefer to have the base salary plus commission. Okay, they give you a base salary and then they allow you to make commission on a certain amount. But someone else in that company may say, I want to have straight commission. And they say, okay, we'll give you straight commission. And then that person makes $65,000 more than you did. Well, you see, obviously it wasn't a good idea to take the base salary plus the commission. It was better to take the straight commission based on the type of company who you are and what you do and what you provide. So here's a question for you. John works twisting pretzels in a pretzel factory. Pablo works in an IT systems integration at a credit card company. The best pay plans for these individuals would be most likely be blank and blank respectively. Here's your answer. And here's your answer. Piecemeal and merit pay. They're 2 different industries. They're doing 2 different types of work. Therefore, they should have 2 different types of incentive programs. Pay for group performance. So the gain sharing. So this is measuring improvements in productivity and effectiveness and distributes portion of each gain to the employees. Addresses challenge of individual appropriate performance measures for complex jobs. Employees determine how to improve their own and the group's performance. So this is where you have this gain share, and this is where basically you're not an individual, you're not getting paid, you're getting paid by the productivity and the success of the group. And this is one of the reasons why if you had a team and you had somebody who wasn't pulling their weight, the people on that team would want that person to be removed because it ultimately affects them and hurts them. Pay for group performance. So conditions for effective gain sharing. Okay, management commitment. So you got to have management committed to this. And I'll give you one of the things I look at when I say management commitment is, are you committed to removing folks who are not doing their part from the team? Because ultimately this is affecting the team's ability to earn extra money. Need for change or commitment to continuous improvement. Always looking to change, always looking for improvement. And when you have people who are forward thinking and their pay is tied to it, that's what they will be doing. How can we be more efficient? How can we get more done to get paid more money? Management acceptance and encouragement of worker input. Allow the people to give you input. Management's job is to make the management decision. It ain't their job to try to know everything that's going on. That's why you have other people in there who are working and doing stuff, but utilize their knowledge and their experience to help you make a good management decision. High levels of cooperation and interaction. And this is where you're going to have high levels of interaction and cooperation amongst the team members, but also with the managers as well. So that you ensure that everything is working well. And bottom line is, you as a manager, you want to help them earn extra money if they can. Employment security. So when you look at the employment, so if you have somebody who's achieving and they're doing really well, they have employment security because it's documented and proven that this team of people they're excelling and they're getting bonuses, every quarter because they are excelling. Information sharing on productivity and costs. And this is where when you're working together in that group, effect gain sharing, everybody's information is shared. Because again, you're working together as a team. As one goes, they all go. As one fails, they all fail. It affects all of them. Goal setting. What are the goals? They're not individual goals, they're team goals. Do you have those set down? Management should have those set down, but also management should take in consideration, stuff that's realistic and talk to the employees to ensure that they're setting goals that are attainable. Commitment of all parties. A process of change and improvement. Everybody's got to buy in. Everybody's got to be on the same sheet of music and pulling in the same direction. If not, you've got somebody pulling in the opposite direction. That's going to be a problem. Performance standards and calculations that are fair, relevant, and understandable. People have to know how they get paid. How do I get, if they get paid something, they got to know how they got it. Employees who value working in groups. Some employees do not value working in groups. Therefore, you would not want them in this particular configuration. But others employees do. So and that means not that they're a bad employee because they don't work in a community. They're not a good fit for this. So group bonuses used in smaller work groups. Reward members of group for attaining specific goals, usually measured in terms of physical output. So when you think in terms of a group that's people, let's think in terms of making something, measured in terms of physical output. How many units of this particular thing did the group make collectively? Not individual, but as a group. Team awards, similar to group bonuses, likely to use a broad range of performance measures like cost saving, completion of project, meeting deadlines. So this a lot of times when you see when people don't make stuff, but they may be white collar people or tech people working on projects. And so they may go through it and figure out a way to actually save money by we save the money $1 million because we figured out doing something this way is a lot more cost effective than doing it the way we've been doing it. They also get a bonus and stuff possibly if they get it completed by a certain, complete the project by a certain deadline. They'll say, well, you got 12 months, which is a year to complete this project, and they get it done in 10. So that's when they will qualify for some additional pay. Pay for organizational performance. So profit sharing. Payments are a percentage of the organization's profits and not part of the employee's base salary. May encourage employees to think like owners. Evidence not clear whether profit sharing is effective in improving performance. May be used as a component of pay system that includes other kinds of pay linked directly to individual behavior. So this is basically profit sharing is this. Think simple. The company has done well. They have made profit. Subsequently, therefore, they're sharing the profit with the employees. And that's all employees. Stock ownership. This is where people have an opportunity to purchase stock from their paychecks. Every pay period, they get a chance to purchase stock should they choose to do so. Stock options is the right to buy a certain number of shares of stock at specific price. Traditionally have been granted just to executives. So now you're finding this more. A lot of times it used to be just executive, but now you see that coming to regular employees. Employee stock ownership plans. So ESOP. Organization distributes shares of stock to all of its employees by placing them in a trust. Most common form of employee ownership carries significant risk. So really, now you talk about stock market. Stock market goes up and down. So this is when they distribute shares to stock to all its employees, but places them in a trust. Well, if the stock of the company goes down, there in essence is your risk. So when you think in terms of types of organizational performance, there's three of them: profit sharing, stock options, employee stock ownership plans. And either way, these are good for, and when you think in terms of this, most people think of these in terms of long term, something that's going to help me long term, possibly for retirement. Number of companies with ESOPs. So look at the number of companies that has those. So you see 1975, there were hardly any. This peak was 2010. And now you see 2016 to 2020, about the same. Polling question. Josh is the director of the marketing at Global Company. Identify the best type of incentive pay for him. Josh is the director of marketing. So individual performance for getting half of his team members to hit individual goals. Group performance for getting his whole team cooperate and hit the marketing department. Or organization performance for increasing the company's profits 20% through their profits. And what do you think would be the best? Balanced scorecard. Balanced scorecard, combination of performance measures directed towards the company's long and short-term goals, used as the basis for reward and incentive pay. So when you look at that, you see the four categories: financial, customer, operations, learning, and growth. So this is when they go through and say we basically have four things that we consider when we look at this balanced scorecard. And based upon those four things, looking upon those, there are certain hallmarks that need to be met in each one of these categories in order to receive bonuses and things based upon that. So participation in decisions. Employee participation can be a part of general move to employee empowerment. Employees have hands-on knowledge, behaviors that are effective. That was what I said earlier. You want employee participation. One of the reasons you want employee participation is this: it's hard for people to say something's not fair when they got to give some input on how and why it got implemented. That they'll buy in because they got to participate. Communication demonstrates that the pay plan is fair. When employees understand the plan, it is more likely to influence their behavior as desired. Especially important when changing the pay plan. The pay plan. Absolutely, you got to communicate with folks. If they understand and believe that it's fair, it's more likely to influence the behavior you want. If they don't think it's fair, they will ignore it, as we stated in the previous slide. Short-term incentives. Bonuses based on rate of return. Return on investment, year's profits, or other measures related to goals. Actual payment of bonuses can be deferred to gain tax advantages. So this is things that you look at the different ways they can do short-term stuff, and a lot of times you got to look at this because it could have tax implications. This is where a lot of times where people might want to speak with their accountant or tax attorney or some financial advisor about what would they like to do with that. And then you have the long term. The long term stock options, stock purchase plans. Rationale is that executives will want what is best for the organization because that will cause the value of their stock to grow. So this is how you're trying to motivate these executives. Performance measures for executives. So you have a balanced scorecard approach is useful. Securities Exchange Commission, SEC, requires executive compensation to be reported. And the reason they require it to be reported is so significant. This is because a lot of times they receive millions of dollars in pay. Dodd-Frank Wall Street Reform and Consumer Protection Act requires that public companies report the ratio of median compensation of all its employees to the CEO's total compensation. So they want to also know is when these executives are receiving their pay, they want to know what percentage of that is employees. And I'll give you an example. What if you have a company that is losing money and the employees are underpaid, but an executive who made $11 million? That would be a problem. So this is why they want these things to be reported. Ethical issues occur when company links pay to stock performance. Executives may be tempted to lie about the company's performance due to the potential for large earnings. Insider trading gives unethical advantage. SEC implemented a new rule in April 2023 designed to close loopholes in buying and selling the shares. Remember, when you're the CEO of a company, you're executive, you have information that others don't have, and you know about things that happen. Give you an example. You know if there's something you get ready to do that's going to cause your stock to go down or cause it to go up. So, but the public doesn't know that, and this is why the SEC is coming through and says, you know what, and your employees don't either. You can't benefit from this because no one else can. And it's illegal. Consequences for executives. So when Wells Fargo managers and employees opened fictitious accounts for existing customers to meet aggressive sales goals, the company's board took the unusual step of not awarding bonuses to executives. So not only did the company board not award these bonuses, and the reason they were doing this, they was creating these accounts because everything was based on like sales and quotas and numbers. So the more accounts they created and opened, the more money they made. So they got to the point they started being dishonest. And this was something that was actually illegal. And this got Wells Fargo in a lot of trouble. And they had to pay a lot of money to the federal government and to clients and people and stuff for for damage that was done to them. And a lot of people were terminated all the way up to the executive level. That concludes this chapter.